All right, welcome everybody. This video is going to go over how to trade a balanced market. There is really kind of two states to the market. You have balanced and imbalanced markets or trending markets. And trading those different types of markets are completely different. In one market type, you have trending markets making higher highs and higher lows, or lower lows and lower highs, and that is an imbalanced market. Trading supply and demand in an imbalanced market is phenomenal. But when we are in a more balanced market, which happens about 70% of the time, the dynamics of trading in a balanced market are actually much different. So if we're taking a look at the NASDAQ on this individual day here, we can see that prices stayed relatively sideways. A lot of people may stay away from markets like this, but there are certainly opportunities to trade in conditions like this, and especially since they happen a lot, but the dynamics are quite a bit different. If we're just looking at price, price doesn't give us a complete story of what's actually going on in the markets. So when we're trading in, I mean, both balanced and imbalanced markets, but specifically balanced markets, you're going to want to take a look at the volume profile as well. So if you use a fixed range volume profile, you can take a session and you can see where the bulk of transactions were actually done on that individual session. In between the blue lines, that is what is considered the value area. That is where 70% of all transactions happened. The red line is the point of control or the highest volume node in that specific session or for your fixed range volume profile. All right. What we need to understand is the dynamics of market auction theory or auction market theory and what's actually happening here. We could see if we were taking a individual price range, well, we might consider this the entire sideways market, right? And at that point, we're actually not going to be able to find too many opportunities. But if we understand that 70% of the transactions on this individual day were done within those two blue lines within that value area, then we can understand where the true range actually is and how to fade the extremes. So in a balanced market state, both buyers and sellers are in relative agreement of price. They are both comfortable doing business in the middle. This can be seen as where transactions are comfy. Both buyers and sellers are comfortable doing transactions within that range where 70% of the transactions have been done. Any attempts to push price outside of the range are usually met with a mean reversion and a snapback inside of the range as well. And we can see this on multiple attempts in multiple occasions on this individual day as well, where prices stretched outside of the value area and then came back inside where the market was comfortable doing business, where the bulk of transactions could get done. All right. So taking this into account, what we can understand is that if both buyers and sellers are comfortable doing business within this price range, well, when prices get outside of the price range to the upside, buyers were comfortable buying lower. Buyers are not going to be interested initially in buying at higher prices. But sellers see those as premium prices and jump on the opportunity to be able to sell at those extremely high prices on the individual day. And they see that as a premium price to sell something at. So there's going to most likely be a discrepancy and an imbalance of selling activity once we stretch outside of the value area. All right. And the same would be true to the downside. When prices come outside of the value area to the downside, well, sellers don't want to sell at lower prices, but buyers are jumping on the opportunity to buy at these discount prices. All right. And so there's going to be an imbalance of buyers once we step outside of the value area, and then there's a reversion to the mean. To trade these balance ranges, there's multiple ways that you can trade them, of course. You have to know some sort of strategy, either price action, order flow, in order to take opportunities once prices are in the extreme discount area or when prices are in the extreme, in the extreme premium areas or in the extreme discount areas, right? And so you can implement whatever price action strategy you have. You can implement any sort of order flow strategy that you have in order to take those trades accurately. And then what you want to do when you're taking these trades is that you want to first target to the midpoint, to the point of control, because that's where the most business can be done. That's where the most business has been done. It acts as a magnet for price. Once we stretch outside of the value area, there is a reversion back to the mean or the point of control. All right. After prices break through the point of control, they will usually traverse the entire value range. But on a safe note, you want to definitely be targeting to the point of control once prices stretch outside of a individual value area. All right. Now we can play this forward and we can see what happened in the overnight session as well. All right. So we come into the overnight session, we start to push above the value area. All right. And then we get a reversion back down to the mean initially. All right. And we can continue to stretch this profile out so that we can see it a little bit better. We have prices come outside of the value area, and then we have a reversion right back down to the point of control. All right. And if we continue to press play here, we'll see prices are outside of the value area once again. And then we get a push back down to the point of control, right? Now prices have broken through the point of control and they will most likely traverse the entire value area range all the way down to the value area low, all right? And then we see that happen here, all right? And then we kind of bounce off the value area low and now we start to break out down below, all right? So you're seeing examples in this market state here of the balance dynamics, that we just simply have to understand that in a balanced market, that buyers and sellers are comfortable doing business in the value area, right? That is where the market is comfortable. It is telling us that, but we won't be able to truly see that by just looking at price. Price is only half the story. The other half is volume. So you need to be able to use a volume profile to understand what state of the market you're in, if you're in a balanced market or imbalanced market, right? And balanced profile shapes are these bell curves, right? These kind of standard bell curves like so, and that would be more of a balanced profile shape as well, okay? So those are the basics. Now you have to implement your various strategies in order to capture these opportunities accurately, but you know when you should start looking for opportunities to fade the market down towards the mean or to buy the market back up towards the mean, right? And it's going to be outside of the value area in both examples, okay? So I'm going to show you some different tools and techniques. Maybe you are a supply and demand trader using a price action strategy. Well, in this example right here, coming into market open, you have a supply zone that existed outside of the value area from the prior day. And if we speed this thing up, we can see that the market, once it opens during the New York session, those boxes are just highlighting the overnight trading session, right? But once we come into the New York session here, it's going to take some time. And we can even stretch this value area out, the profile out even more here, all right? You can see that there's not a lot of volume being transacted in the pre and post market, all right? But then once the market opens, we come up right up to a supply zone, right? Right up to a supply zone outside of the value area, right? Which provided a beautiful shorting opportunity initially back down to the point of control, but then we just traverse the whole range, a lot more volatility once the New York session opens, right? And then we can see that prices stretch outside of that value area and come right back inside, right? And so this is really the dynamics of what you're trying to look for, of where you're trying to find your opportunities. You don't want to try to diddle in the middle, as they say, all right? Is that the best quality opportunities are going to exist at the extremes or outside of the value area of a various balanced profile, right? So if you're using price action, you might be looking at supply and demand zones. You might be looking for reversals, things like that, if you're just looking at price action. If you're using some sort of order flow tools, for instance, We could take a look at this level down here, both pre-market and in the New York session, and both provided great opportunities when you see a dynamic of effort versus reward, right? So here are the two levels. This is one of the order flow platforms that I use. And if we just zoom in on that pre-market level, we can see that there is a lot of aggressive selling to the downside, but no follow through. And then it's followed up by aggressive buying right here as well. That would be one of my entry signals. And then we can see that we get that really good push into the New York Open, back up into the value area. All right. If we take a look at the retest of that level, right, during the New York session, same sort of dynamic plays out there as well, where the market comes down. There's a lot of selling effort down here, but no reward for their efforts. The market comes up, puts in a higher low. Those sellers are not getting rewarded. And then we revert back into the mean as well. All right. So those are really the dynamics for trading a balanced market. And the markets will stay in balance until one side of the market is willing to pay worse prices and willing to accept worst prices, right? In this example right now, no side of the market is willing to accept worse prices. When we stretch outside of the value area, is that there's a clear imbalance from one side of the market and we snap back into the mean, right? In order for the markets to truly break out of balance, there needs to be acceptance. And what does acceptance look like? Acceptance looks like some basing or the market holding balance outside of the value area, and then you see continuation. That's called an initial range breakout or initial balance breakout. And then these opportunities are usually phenomenal opportunities to enter in on a retest. And if we just simply hit play in the markets here, we actually got that on the NASDAQ here today, where we start building value higher and then we get that breakout, right? So we are building value outside of the value area, right? By basing. And what does this show us? This shows us that in areas where there was a lot of selling before, now, since prices are staying stable, buyers are now accepting these prices, right? They're saying, okay, you know, we were only willing to pay these prices before, or the extreme discount prices before, but now we're willing to pay higher prices. And then you see that continuation. So for a true breakout outside of a balanced range, you need to see value being built, aka basing, and then continuation from that same side of the market. And that's what you need to look for. That is one of your models that you should implement in your playbook for trading outside of balance for continuation. Hopefully that helps you guys a lot. A really kind of short video, but just highlights some of the principles of auction market theory, supply and demand, of course, and trading in balance versus in imbalanced market. Thanks so much.